Well, all right, all right. So today we have Brandon Hall. Guys, he was on my podcast. Hopefully you listened to that episode because it was killer. Brandon is a certified public accountant, national speaker, and is the founder and managing partner of the Real Estate CPA. Brandon works with real estate investors, syndicates, and private equity funds to optimize tax positions and streamline accounting and business functions. He believes that real estate investing is critical to building sustainable and generational wealth. Brandon worked at PricewaterhouseCoopers and Ernst & Young prior to launching his own CPA firm, Hall CPA PLLC, the Real Estate CPA. Through the knowledge gained by working with real estate investors, Brandon has built a real estate portfolio for himself and his family of 25 units consisting of multifamily, single family, and short-term rentals. Brandon, my man, thank you so much for joining us tonight.
Thanks for having me on. I appreciate it.
All right, my man. So let's do this. I know you have some sort of presentation. If you don't mind sharing your screen and rocking that, you have the choice or the option of having people kind of ask questions throughout or hold their questions, and we will honor that wish of yours.
Yeah, just ask questions throughout. That'll be the best thing. So anytime, and I'll stop periodically too to see if we have any questions. And you can ask questions in the chat. I'll have that open. Or if you just want to come off mute and ask, that's totally fine. You can interrupt me. Let me actually pull the chat up here. There we go. Okay.
All right. Just type in the chat box. We'll address as it comes.
Cool. All right. Thank you all for having me and coming to a tax presentation. I really appreciate that. My name is Brandon Hall. I run the Real Estate CPA. We are a national accounting firm. I have 30 employees and we have about 700 clients across the United States. We are in every state, and all of our clients are in real estate. So I got the start back in 2015, 2016. I was trying to figure out how to invest in real estate so that I didn't have to work anymore. I was really tired of working, and I was only I graduated school 2013. So, I was like 2 years into my career and I was like, I don't want to work. So what can I do? And I kept finding rental real estate. I found Bigger Pockets. I was asking questions about investing in rentals. I bought a 3-unit back in 2015 and then started doing the math on that 3. I mean, it was amazing. It's still amazing. I still have it today. It like cash flows, the cash on cash returns in excess of 20% every year. So I'm very spoiled with it. And it was my first investment. But even then, even still, I was doing the math and I realized that it was going to take me like, 15, 20 years of investing in rentals to replace my future, what I wanted to be paid, my future W-2 wage. So that's when I kind of pivoted and said and asked, how can I get out of the corporate world faster? I don't want to wait 15 to 20 years. So I started looking at different businesses that I could run and kind of just stumbled into answering tax questions on Bigger Pockets at the same time. And after I did that for a while, people started reaching out and asking if I was taking on any clients. And that snowballed into what we have today. So we are probably, if we're not the fastest, we're among the fastest growing CPA firms in the United States. We have gone through ups and downs. Last year was we grew 45% last year, but we also had turnover of 44%, which I talk openly about, and we're on much more stable ground today. But it's been a really interesting entrepreneurial journey for me. I'm a young guy and just trying to build a ton of leadership skills and business skills as quickly as I can. So anyway, I've got 30 employees. We provide tax planning, compliance, like preparation, and accounting and CFO services to real estate investors. We have really small clients that have one property, and we have extremely large clients. So we have a couple private equity funds. Our largest fund has $1 billion AUM. We are their CFO. We manage their entire accounting department. We interact with all their investors. There's thousands of them, and they buy 1,000 single family homes a month. So it's insane work, but really fulfilling work and really cool. They chose us over Aprio, which is a really large accounting firm, and they chose us because we told them that we would bridge our Slack channel with their Slack channel, and these guys are like an ex-Google guy and Uber guy, and they thought that was really cool. So anyway, tonight what we're going to do is talk about how you can use certain pieces of the tax code to make your portfolio a little bit more tax efficient. I am a very big proponent of claiming as much as you can in deductions today. For the most part, I don't really care what tax bracket you're in. A lot of people will say like, well, if I'm in the, the 20% roughly tax bracket, then maybe I don't want to claim all those tax benefits today. I still say go for it. The time value of money is incredible. Inflation is going to eat away at your tax benefits, and I'll talk a little bit about that here in a minute. So my suggestion is to maximize. Always optimize, and optimization means maximize those tax deductions. So we're going to talk about how you can do that today. We work with a ton of multifamily investors. We work with a lot of syndicators. We help structure operating agreements. So this is all going to be right up your alley. The very first thing that anybody that's investing in real estate, there's tons of things that you can do out there to get tax deductions, right? You can set up your home office, you can travel, you can take people out to dinner and do business meals and all this type of stuff. So that's what I consider low-hanging fruit. The real magic is understanding how the passive activity loss rules work. And I talk about this all the time. I'm like a broken record with this type of stuff. So if you've listened to our podcast, if you've been on any of my other trainings, then you've probably heard this before. But the passive activity loss rules are where you need to start, because that's the very beginning of understanding how do I absolutely optimize my tax position. So the passive activity loss rules were created in 1986. Before 1986, there were no passive activity loss rules, which meant that there was no distinction between what is a passive activity and what is not a passive activity, which meant that I could be a physician earning $600,000, $700,000, $800,000, and I could go buy a piece of rental real estate. I could cost segregate it, get bonus depreciation on it, and I could wipe my income out and not pay any tax. So high income earners were using rental real estate as a tax shelter. And the passive activity loss rules were put into place in 1986 to prevent high income earners from using rental real estate as a tax shelter. So when I see people promote rental real estate as this like amazing tax shelter, I like to just remind people of the caveat of these rules were put in place to prevent the tax shelter. So be really, really careful when you're trying to go down this rabbit hole of the passive activity loss rules to maximize your tax savings. You can do it right, and you can also do it very, very wrong. So the passive activity loss rules, they came into play in 1986, and they created two buckets of income. They created the passive bucket of income and the non-passive bucket of income. And I'm not talking about your, there's other types of income too. There's the ordinary income, portfolio income. I'm not talking about any of that. We're looking specifically at the passive activity loss rules today. So it creates two buckets of income, passive and non-passive. And it says, these rules say that anything in the passive bucket, if you create losses from activities in that passive bucket, then those losses are suspended and they're carried forward. And the whole purpose of making those rules, suspending those losses and carrying them forward was, again, to prevent people from investing in rental real estate and using that as a tax shelter. Okay. So instead of buying this rental, cost segregating it and just wiping out my W-2 income, now I'm buying this rental, I'm cost segregating it, but it's flowing into the passive bucket. My W-2 income and my business income is in the non-passive bucket. And because my rentals have passive losses, those passive losses cannot offset my W-2 income and my business income. They just get suspended and they get carried forward. And I can use them eventually when I die, or if I create passive income or sell a passive activity at a gain. But I cannot use those passive losses to offset my W-2 income. So that's what the passive activity loss rules say. Two buckets of income. All rentals are by default a passive activity. So they're stuck in that passive bucket. You can jump it out and into the non-passive bucket. And we're going to talk about how to do that here in a second. But all rentals are by default a passive activity, which means that they go into that passive bucket. And if those rentals produce tax losses, then you cannot use those tax losses to offset your W-2 income and your business income, your interest income, your capital gain income. All of that goes into the non-passive bucket. It's a different bucket. Okay. Now, I was gonna say something about the losses, but I just lost it. So anyway, so there's a few exceptions to these passive activity loss rules, and the exceptions are important because If I qualify for an exception, then I can move my activity out of the passive bucket and I can move it into the non-passive bucket. And again, that's important because if I make $300,000 from my CPA firm, so that's my net profit from my CPA firm, and then I go and I invest in a $1 million eightplex, I cost segregate it, and it gives me a $250,000 tax loss. If that's a passive tax loss, then I cannot claim that tax loss against my CPA firm net income. But if it's a non-passive tax loss, meaning that I qualify for an exception to the passive activity rules, then I can use the $250,000 tax loss to offset my $300,000 of CPA firm income. And I have a net income of $50,000 after it's all said and done. And that's what I'm going to pay taxes on. So I'm not paying taxes on $300K of CPA firm income. I'm paying taxes on the $50,000 net. So really, really powerful if you can move rentals out of the passive bucket and into the non-passive bucket. And I did remember what I was going to say. I don't know like where everybody's sophistication level is. So I'm going to back up and talk about the losses real quick. Rental real estate is an amazing tax shelter because most rentals produce tax losses even when they're producing operating income. And a good example of that is, let's say I buy a property and I have net cash flow of $10,000. So that's $10,000 of cold hard cash that hits my pocket. It's physical cash that I can take and I can go redeploy. But thanks to depreciation, I may tell the IRS that I lost $2,000. That's the tax loss, right? So maybe I have $12,000 of depreciation and I have $10,000 of actual cash flow, but I net out the cash flow from my depreciation. And after it's all said and done, I have a $12,000 expense minus $10K of cash flow. It's an extra $2K of expenses, which basically means that I have a tax loss of $2,000. So I didn't pay tax on the $10,000 that I received because my depreciation wipes out the tax issue, the taxable income with that. But the depreciation also gives me a $2,000 tax loss that I can then try to figure out if I can move that over into that non-passive bucket and use it against my W-2 income. If I can't move it into the non-passive bucket, then my $2,000 tax loss just becomes suspended and it gets carried forward. But it still benefited me. This depreciation still benefited me because I earned $10,000 of cash flow from this rental activity and I didn't pay tax on it today. So sometimes when we go through these types of presentations, people will always ask, well, I can't qualify as a real estate professional, or I can't qualify for one of these exceptions. So, rental real estate's not that beneficial for me. And that's not true. You just have to take the Warren Buffett approach to investing, right? Everybody always says Warren Buffett pays less taxes than his secretary. No, he doesn't. But his effective tax rate is less than his secretary's, right? Warren Buffett pays millions of dollars in taxes, but compared to his total income, the ratio of tax compared to his total income is lower than his secretary's total tax compared to her or his total income. So it's really important to understand that even if you can't qualify for these exceptions, even if you have suspended passive losses, investing in rental real estate is still extremely tax advantageous because you're creating income streams that you're not going to pay tax on. Your current income stream, you might not be able to do anything about. But these future rental income streams, you're not going to have to worry about paying tax on, or you're not going to pay as much tax on. I mean, even if I earned $10,000 of net income and I only had $9,000 of depreciation, so I have a $1,000 taxable income, even if I'm in the highest tax rate, 37%, I'm going to pay $370 on my $1,000 in net taxable income. But if you look at the entire cash flow that I earned, it's $370 on $10,000 of cash flow, a 3.7% effective tax rate. Pretty darn good. Okay. So that's the power of investing in rental real estate. But what we're going to talk about now is when I invest in rental real estate and that depreciation or my repairs and my rehab, all that type of stuff, it creates a tax loss, whether or not I have an operating loss or income. What I do have is a tax loss. Can I use that tax loss? The passive activity loss rules say no, it gets suspended unless you qualify for one of three exceptions. So the first exception, you dispose of your rental property. If you sell a rental property at a gain, you can use any suspended passive losses from any passive activity. So a lot of times we'll hear about CPAs or tax advisors saying, rental A's losses could not offset rental B's income or rental B's gain on sale. And that is not true. It absolutely can. It's all one bucket. The one bucket is the passive activity bucket. So if it's a passive activity, it doesn't matter if it has income or losses, they can all net out against each other. If you ever run into CPAs that give you pushback on something like that, ask them to prepare Form 8582. That's Form 8582. That is the most important form for real estate investors to know. It's more important than your Schedule E, more important than Schedule C, more important than your 1040. Form 8582 aggregates all of your passive activity income and losses together. And when tax preparers prepare a pro forma or like a projected Form 8582, they're shocked that all the passive activity income and losses net out against each other. But like the cool thing about that netting effect is that I could have a rental property that loses after depreciation, or has a tax loss after depreciation of, let's call it $10,000. Excuse me. So I have a $10,000 tax loss, right, from my rental. Then I go and I put $100,000 into a hair salon where I'm a passive partner. Okay, I'm not materially participating, and they're going to allocate to me roughly $10,000 of net profit every year as a result. So I'm just a money guy in this hair salon. But because I'm just the money guy, this is a passive investment for me. I have an equity stake, so it's not debt. It's equity. It's not a corporation. It's an LLC, so it passes all through. But I get allocated $10,000 of passive income from this hair salon. Well, my rental losses, that $10,000 of rental loss can offset the hair salon $10,000 passive income. This is the rich dad, poor dad, that whatever, I forget whatever quadrant it is, but that's the idea of rich dad, poor dad. So you create all these streams of income, but I like to take it a step further and say, let's create all these streams of income, but let's also have them net out against each other. So really important to understand, and Form 8582 will show you that netting effect. The second exception to the rule. So the first exception was sell the rental. If you sell the rental, you can use the losses. The second exception is to earn less than $100,000. I know that I put $150K here, but less than $100,000 allows you to claim up to a $25,000 passive loss allowance. So if I earn less than $100K and I go and invest in a property and it produces a $10,000 tax loss, I can use that tax loss today. If it produces a $30,000 tax loss, I can only use $25,000 of that $30,000 tax loss. All right. So that's if I earn less than 100K. Now it goes up to 150K, but it phases out. So as my income creeps up above 100, that $25,000 allowance that I'm allowed to claim starts phasing out, and it's completely phased out when I reach $150,000. The third exception to this rule, and again, what are we talking about? We're talking about trying to get these losses out of that passive bucket and into my non-passive bucket, because my non-passive bucket is where all of my other income is, right? It's my W-2 income, my business income, my interest, capital gains, all that type of stuff. So it's really important if you want to optimize, you want to maximize for time value of money or optimize for time value of money. It's really important to move those rentals over into that non-passive bucket via one of these three exceptions. That third exception to the rule is qualifying as a real estate professional. Qualifying as a real estate professional. Oh, I was just like looking at the chat and I saw, how's the deal search? And I was like, oh, I don't know. Wrong audience. Got it. Qualifying as a real estate professional. So really interesting piece of the passive activity loss rules. And this is what a lot of our clients gun for. If you qualify as a real estate professional, let me explain the why behind it. If you qualify as a real estate professional, all of your rentals can be moved out of that passive bucket and into the non-passive bucket. So I can use rental real estate to an unlimited effect or an unlimited amount to offset my other income, my non-passive income. Really powerful if you can qualify as a real estate professional. You have to spend 750 hours in a real property trade or business, or multiple real property trades or businesses. You also have to spend more time in real property trades or businesses than you do anywhere else. So spend 750 hours and more time in real property trades or businesses than you do anywhere else. If you can meet those two tests, you qualify as a real estate professional. If you have a full-time W-2 job, you cannot qualify as a real estate professional because you're not going to meet that second test, more time in real estate than anywhere else. You're not going to be able to justify spending an additional 2,001 hours on top of your 2,000-hour W-2 job. Even if you could do it physically, the IRS is not going to buy it, and neither is the tax court. So So if you have a full-time job, you're out. You can't qualify as a real estate professional, but your spouse could qualify if your spouse stays at home with the kids, or if your spouse has a part-time job or runs a business part-time. So your spouse can also qualify. And if one spouse qualifies, then on a joint tax return, the entire tax return is considered real estate professional status tax return. So you will reap the benefits if your spouse can qualify. Now, you see here, I say real estate professional status really means nothing. It simply allows you to overcome the presumption that your rentals are passive. And that is true. So once you qualify as a real estate professional, you also have to materially participate in your rental activities. And there's 7 tests of material participation, which I don't think that I've got on here. And it's just going way too deep into the weeds, but you also have to materially participate. So you have to meet one of the 7 material participation tests. The 3 of the 7 that we see most often are your participation is substantially all of the participation, meaning you self-manage. The second is you spend 100 hours and you outwork everybody else. And then the third is you spend 500 hours on your rental activities. So that if you meet one of those, then you will be materially participating in your rentals. The significance of this is that I could be a real estate agent or a wholesaler or a flipper or a builder full-time, right? That's all I do. I'm brokering deals, I'm building, I'm flipping, whatever. I'm doing that full-time. I'm a real estate professional because I spent 750 personal service hours in a real property trader business, and I spent more time in those real property traders businesses than I did anywhere else. I did this full time. But qualifying as a real estate professional in and of itself does not mean that my rentals are automatically non-passive. Okay. So I could be a real estate agent full time, but my rentals could still be passive. I have to come back to my rentals and I have to materially participate in my rentals to push them out of that passive bucket and move them into that non-passive bucket. All right. So just remember that if I hit my real estate professional status hours, the 750 hours and more time in real estate than anywhere else, if I hit that by being a landlord, then I'm also going to hit material participation at the same time. You kill 2 birds with 1 stone when you're basically a landlord full time. So for everybody here that's like sponsoring multifamily deals, putting these deals together, buying multifamily deals for yourself, there's a good chance that you can qualify as a real estate professional. It just kind of depends on what else you do income wise. If you're running a business or a W-2 job on the side, or I guess you have a W-2 job and you do real estate on the side. But so you're doing bigger deals. Our multifamily investors have an easier time qualifying for real estate professional status because they're doing larger deals. It takes more time to get it done. And once you do qualify, because you're investing in multifamily, the tax benefits are ginormous. So it's way better than buying a single family home or even a small duplex. The larger the multifamily, the juicier the tax benefits. So this is really important stuff for multifamily investors to understand. Now, when I start talking about real estate professional status, people start asking me, well, what hours count and don't count? Because you have to hit 750 hours and spend more hours in real estate than you do anywhere else to qualify as a real estate professional. Investor hours do not count unless you're involved in the day-to-day management of the activity, which means you don't have a property manager. You're doing it yourself. Investor hours are time spent doing the bookkeeping, reviewing financials, paying bills, filing your tax returns. All of those hours are considered investor hours. They will not count towards your 750-hour test or the more time in real estate than anywhere else test. Education and research time will not count. And when I put italics there, that's just tax court cases that support the statements that I'm making. So you're more than welcome to Google these tax court cases and read them in depth. But education and research time will not count towards the 750-hour test and the more hours in real estate than anywhere else test. Travel time may not count. It depends on how local the travel is to you. If you have to get on a plane or drive a couple hours, then the travel time is not going to count. If you have a bunch of rentals that are local to you and you're visiting them daily because you're self-managing, that's travel time that will count. And that was discussed in lay versus commissioner down there, that last bullet point. The other issue that I like to remind people of is real estate professional status is a highly litigated piece of the code, very highly litigated. You should not play games. So we work with a lot of investors, typically new, or they've come off of some sort of like training program. and they've got a dead set in their mind that they're going to qualify as a real estate professional. And we typically have to talk them out of it and help them understand why it's not going to happen for their particular case. And we like to remind people that this is an extremely highly litigated piece of the code. You do not want to play games in this area, but if you can do it, if you can qualify as a real estate professional, you absolutely want to. So qualifying as a real estate professional, again, allows you to move the rental out of that passive bucket and into that non-passive bucket. And now that we're in this non-passive bucket, I can do things to accelerate depreciation. Like I can get a cost segregation study performed. I can claim 100% bonus depreciation, and it's going to give me a really large tax loss that is in my non-passive bucket. And that non-passive large tax loss can now be used to offset my W-2 income, my business income, whatever other non-passive income I have. And that act is going to give me a really large tax refund that I can then use to go and reinvest in real estate and do it all over again. So real estate professional status works really well when you're in acquisition mode. Most of our clients are in acquisition mode every single year. And you just continuously produce these large tax losses that can eliminate your income and therefore eliminate your tax bill as well. And again, every once in a while I run into folks that will say, well, I'm in a low tax bracket, or I'm going to be in a lower tax bracket, or it's going to put me into the 15% tax bracket if I do this. So I don't know if that makes sense. Or when I take bonus depreciation, it reduces my adjusted basis in the property. So when I sell it later, I have a larger gain. And some of that gain is depreciation recapture. And that depreciation recapture is taxed at a higher rate, my marginal rate. And that is all true. But what is also true is the fact that you have predefined tax benefits sitting in every single one of the properties that you buy, right? So think of every property that you buy like a bank account. Now, everybody knows not to go and leave cash in a savings account that yields 0.1% interest, right? Obviously, we all know that, because we also know intuitively that inflation is 6 to 8%, depending on who you ask. And if I'm only yielding 0.1% on the cash sitting in my savings account, then I'm losing purchasing power to the tune of 6 to 8% per year. Well, the same thing is happening in your rental properties, because in your rental properties, when you buy them, you have predefined tax benefits in those rental properties. You can choose to do nothing. You can choose to leave it in the savings account and claim depreciation every single year for 27 and a half years. Or you can choose to accelerate as much of that depreciation now to give you a large tax refund now. I would rather have my tax refund now so that I can reinvest my tax refund now. I don't want my tax refund to come out over 27 and a half years, because 27 and a half years from now, my tax refund that I'm going to get in that 27th year is going to be like negative. It's going to be like I'm paying the IRS, So it's really important to kind of think about these rental properties as bank accounts, and even further, think about them as a savings account as it pertains to your tax benefits. You want to get them out of that savings account as quickly as you can. So you want to accelerate that depreciation, get the tax refund now, reinvest the tax refund. Don't go buy a Ferrari. Okay. We have had clients do that. And those are the clients that get upset when they sell their property later and they have a really large tax bill, because now they have to go sell their Ferrari to pay the tax bill. So don't go do that. Reinvest, continue building the wealth, and you will be totally fine, even though you have the recapture at some later point. All right, now my breakout group, we were talking about short-term rentals, vacation rentals. So I want everybody that is investing in a short-term rental or vacation rental, pay attention to this. So we just spent 20 or so 25 minutes talking about the passive activity loss rules, how rentals are automatically passive. You have to qualify as a real estate professional. To do that, you have to spend 750 hours, more time in real estate than anywhere else, in order to move the rental out of the passive bucket and into the non-passive bucket. But the interesting thing about the Internal Revenue Code is that words are very important and definitions are very important. And technically, what the passive activity loss rules say is they say all rental activities by default are passive unless you qualify as a real estate professional. That is technically what they say. So it would be good to find out what they define as rental activities, right? And when you do a little bit of research, you find this section. You find that A rental activity, a rental is not considered a rental activity. The definition of a rental activity, if the average period of use of customer use is less than or equal to 7 days. That should say less than or equal to 7 days. So if you rent a property less than or equal to 7 days on average to your customers, which most vacation rentals do, then you do not have a rental activity under the passive activity loss rules. And again, that's really important because the passive activity loss rules say all rental activities are passive unless you qualify as a real estate professional. So if I don't have a rental activity, then I don't have to worry about qualifying as a real estate professional to make this rental activity jump from the passive bucket and into the non-passive bucket. All I have to do is materially participate in the rental. Okay. And if we, and I mentioned those 3 material participation rules a few minutes ago, and I'll say them again, but the 3 rules are: the first is that your participation is substantially all of the participation. Well, if I spend, in theory, now this is where I have to say I'm not your CPA, so take this with a grain of salt. Don't just go implement this based on what I'm saying tonight. But in theory, with a very narrow reading of the code, if I spend 20 hours working on my short-term rental for the year, and I meet this less than or equal to 7 days of average period of customer use, so that I don't have a rental activity, my participation, my 20 hours that I spend managing it, cleaning it, yada, yada, that's all the participation. I self-managed it. I did all the cleaning myself. Nobody else touched it. I did all the repairs. I never relied on contractors. All I did was spend 20 hours during the year managing this property. Technically speaking, I would be materially participating because the first test, or the lowest bar, the lowest threshold test, is that my participation in the activity is substantially all of the participation. Well, if I spent 20 hours and nobody else spent any hours, then we're looking at 20 hours divided by 20 hours. That's 100%, right? My participation is 100% of the participation. Therefore, my participation is substantially all of the participation. So I'm materially participating. Now my short-term rental is a non-passive activity. Now I can cost segregate it. Even if I have a full-time job, even if I work at a CPA firm full-time, I can do this with my short-term rentals. I don't have to qualify as a real estate professional. So qualifying as a real estate professional, that's the blocker for long-term rental owners, because you have to spend more time in real estate than you do at your W-2 job or your business. But with this, because it's not a rental activity, I don't have to worry about that. So I can do this with a full-time job. I can do this running a business full-time. I can buy rental real estate. And as long as I materially participate in the vacation rentals, the Airbnbs, the VRBOs, then I will successfully jump that rental from the passive bucket and into the non-passive bucket, where I can then cost segregate it, create large tax losses, and use those tax losses to offset my W-2 and business income. All right. Before I hit this, let me hit a couple questions, if that's okay. How much time do I have, by the way? I should have asked that.
Oh, Brandon, you are killing it, man. We are all like mesmerized. Thank you. We have as much time as you need. Typically,
Okay.
though, we go until 8, but take your time.
Cool.
These questions. I saw people perk up as soon as you started talking about the real estate professional status. So let's hit them.
Okay. All right, Anthony, you asked. Yosef asked, what is your fee schedule? You can find that at our website, www.therealestatecpa.com. We don't have like our full fee schedule. You can kind of learn a little bit about how we work and what our prices are. Anthony, you asked, what if you make more from real estate than you do in your W-2? Do you mean like your net, your operating income is more than your W-2? Is that what you mean?
So my theory, I was speaking to one of the cost seg guys that's in our group, Boomer, you might know him.
Yeah.
And so actually I saw you guys, I listened to the podcast you did. And so you took the wind out of my sails a little bit, because what he was saying was that if you get your so my W-2 is much higher than my rental income at the moment, right? So my theory was take the W-2 down a little bit. I do outside sales, so it's flexible. I could say I work less hours, or maybe I do work less hours, whatever. So bring the passive income up, bring the W-2 down. Say they're both at 250, but the rentals at 251 passive income. Then could you be considered a real estate professional, because you're technically making more than your W-2 job?
Great question.
What's that?
That's a great question. Yeah. You probably know the answer, but I'll just say it for everybody else. The only thing that matters is the hours. So as long as you spend more hours in real estate than you do your W-2 or business, then you'll meet that test. And we work with a lot of like physicians and nurses that they'll do like 6 days on and 6 days off. And so they'll say, well, I'm half on, half off, and all that type of stuff, right? I do Monday, Tuesday, Wednesday, and Thursday, but not Friday, Saturday, Sunday. And what I then ask is, okay, but on your shortened schedule, how many hours are you working? And it still comes out to be, a 45, 50-hour work week. So the important thing to understand with this is it's not about how many days you work. It's not about how much money you make. It's about the number of hours you're pouring into your W-2 job and your business compared to real estate.
Yeah. Cool. Thank you.
No problem. Vanessa, you said your husband and you own a construction company and only do construction on your new property, on your own properties. Would you be able to qualify as a real estate professional if all of your time is spent on real estate? Yeah. So you are probably, at the risk of giving you bad advice, because I don't know your situation at all. But if you are only doing construction and that's all you do, then yeah, you're a real estate professional. Now, the question is going to be, do you have rentals? And if yes, do you materially participate in those rentals? Because you can be a real estate professional by being a construction owner or business owner full-time. You are a real estate professional. But if you don't materially participate in your rentals, then your rentals are still going to be passive. So you have to always come back to the rentals and figure out how to materially participate. Again, there's 7 tests for that. The 3 that we see most often: your participation is substantially all, meaning you self-manage. Your participation is 100 hours and more than anyone else, meaning you outwork everybody else and you log at least 100 hours, or your participation is 500 hours across your portfolio. So you do always have to come back and manage those rentals. I hope that helps. Federico,
Yes, thank you.
Oh, great. Cool. You said for the 750 hours, do you have to have a logbook as far as the time confirmation? Yes, you do. Great question. Actually, I forgot to mention, I did a presentation on this last night to a group of investors. Forgot to mention that there too. But yeah, you do. You need a time log, and that time log needs to be updated. I say daily, just to kind of plant it in your mind that you need to do this. You need to make a real habit of it, because again, it's an extremely high litigated area of the code. So get a logbook. You can do a Google Calendar. It doesn't have to be a logbook, but most of our clients use G Sheets because you can put it right on your phone. And it's like Excel, and everybody knows Excel. So you do something, but you need to log the date, how many hours you spent, what property it was for, and make sure that you leave good notes. Good notes are not sent emails. That's not a good note, because 3 years from now, when you get audited and the IRS agent is asking you about that email entry and it just says sent emails, it's going to be extremely painful for you to try to substantiate that. So you want to be specific. I sent emails to Brandon about questions with real estate professional status, right? Like, it needs to be very specific, and it doesn't take long. It doesn't take a whole lot of work to be specific, but make sure that you're doing that, and make sure that you're being honest about your hours too. A lot of times we'll get time logs when we're preparing tax returns. Like we will not claim real estate professional status for any of our clients unless they furnish a time log, because it's just so highly litigated. And if you work with CPAs that take your word for it, that's a red flag, and I would be really, really careful, or at least just make sure you have your own time log. But we see funny things in these time logs all the time. I mean, we've had time logs where there'll be 500 entries for emails. Every single entry will be exactly 1 hour. And that's something that's never going to hold up, right? We've seen entries where it's like 9 hours to set up a VRBO listing. And I used to believe that setting up Airbnb and VRBO listings took a lot of time, until I did it myself and realized it only took about an hour for my short-term rental. So now you just don't buy that type of stuff. So you got to be realistic. You got to be honest, and you can't really stretch it, because some of these IRS agents, they invest in rental real estate. Some of the tax court judges invest in rental real estate. So they're applying their own experiences as they're looking at your situation, and you have to prepare for that. But yes, to answer your question, long answer to your question, you do need a time log. Jay, you said, is using a property manager to manage property on a short-term rental considered a passive activity. So if you have a property manager on any rental activity, the IRS will take the stance that you are passively involved, that there's no way that you can be materially participating in that activity. And that's where they start. So you would then have to fight them on why that's not true. And that is going to be a losing argument 9 times out of 10. You can successfully substantiate that in certain circumstances. Maybe you're the GP on a syndication deal. That's a situation where you could still qualify as a real estate professional, even though you have a property manager managing the day-to-day of your 200-unit apartment complex, right? Other situations would be if you split duties with your property manager, like maybe they just manage the day-to-day maintenance requests, but you manage everything else. You manage the leasing, you manage the turnover, you manage the repairs, like the major repairs. You manage the contractors related to that. So there are certain circumstances where you can have a property manager and still qualify, but you still have to understand that the IRS will always take the stance that you do not qualify if you have a property manager, and you have to then fight them on it. And it's just, 2 times as hard as just not having a property manager. So do you have an example of a time log of what is considered strong in the IRS's eyes? I'm trying to think if I wrote a 12,000 word guide on this. You can download it as an ebook. It's like a 35-page ebook, I think. It's on our website. If you go to therealestatecpa.com, click resources, you'll find that guide. I think that there's an example there. I think. But if not, you don't really, thank you. You don't really need something super crazy. You just need date, what property was I working on, how many hours was it, and what did I do, the notes, right? You can use a spreadsheet, and that's totally fine. It's totally fine. All right. So we just talked about.
Let's skip the one question, Lens.
Oh, I did.
Above Vanessa.
Oh, sorry. Lance, have you worked with real estate agents who invest in syndication deals and use the K-1 losses to offset against their real estate agent income? Yes. If so, what's the most common test they have to pass? Yeah. So if you are a real estate agent, you are a real estate professional, right? So that's the first major hurdle. If you're a real estate agent full time, I should say. So anybody can go get a real estate license, but if you're working that W-2 job and you're doing the real estate license on the side, you're not a real estate professional because you can't spend more time in real estate than you can at your full-time W-2 job. So really important distinction to understand. Simply getting my real estate license, it might make me a real estate professional on LinkedIn, but it's not going to make me a real estate professional in the eyes of the IRS. But if you are a real estate professional, if you're a real estate agent full-time, then you are a real estate professional. You can go and invest in syndications, but if you don't materially participate in your own rental portfolio, then the investments that you make into syndications will automatically be passive. Okay. So if I'm a real estate agent and the very first real estate investment that I make is a syndication, as a limited partner, there is no way for me to materially participate. There's no way. It's literally impossible. The only thing that I could do as a limited partner is education, research, travel, and investor hours, none of which count, right? So I cannot materially participate in a syndication investment if I'm a limited partner. So that's the only investments that I've made. Then all of those are still passive. They cannot be non-passive. This is very, very important to understand because tax software, all the professional tax software that we all use simply has a little tick box that says, am I a real estate professional? And then you just tick that box. And if you're not careful, all of the rental activities become non-passive, but that's not how it actually works. So some CPAs will simply tick that box and they'll see a massive refund and then they'll call you up all excited that they just got you a really big refund. The problem is that you'll be really excited for a couple of years. Then you're going to get audited. Then you're going to have to pay all that tax back, plus like a 25% penalty for understating your taxes, plus all the interest associated with it. It's going to be extremely expensive. So really important to understand that if I don't have rentals, then any investment that I make into a syndication is always going to be passive. There's no way for me to make that non-passive. But if I'm a real estate agent, again, I'm already a real estate professional, so I'm good because I'm a real estate agent full-time. If I then go and buy my own rentals, I buy like 2 or 3 single family homes right up the street from me. I self-manage those 2 to 3 single family homes. Collectively, between all 2 to 3, I spend 500 hours managing the 2 to 3 rental homes that I own. Okay. Then I can make an election to group all of my rental activities together and treat them as one activity for the purposes of material participation. So if I hit that 500-hour test, again, that was one of the tests for material participation, I can make that election and I'll be materially participating in all 3 of my rental activities. So all 3 of my rental properties that I self-manage will all be considered non-passive, which is great. But at that point, I can also then go and invest in syndications as a limited partner. And because I've made this election, that syndication investment gets grouped in to my 3 rentals where I've already materially participated. So the syndication investment also becomes non-passive. Okay. So you can definitely do this. You just have to do it right. And a lot of times we'll see people just go and invest straight into syndications without first, you have to build your own portfolio first. You have to materially participate in that portfolio, and then you can go and make those syndication investments and make those losses non-passive. We see this mistake a lot. Syndicators like to tell people, like to tell potential investors about the tax benefits. And they don't understand how it works either. And so everybody just gets confused, and then people will either take the tax losses because they see the K1, it's a $90,000 tax loss, and they'll figure out a way to code it into the software that makes it actually show up on their 1040. And then they just become an audit nightmare at some later point. And the IRS has a very high success rate of catching those things because they've got all the information in their system. It's all automated. They will get you. So just be really careful if you're making those LP investments. Make sure that you really understand the material participation rules and whether or not the loss that you've received is something that you can actually claim. And you can do it if you structure it right. And then we have Lance, you got a follow-up question, so I'll answer that real quick. What if the real estate agent as an LP works with the management team as consulting hours? I don't know. I think I would have to kind of learn more about your structure, but typically if you just like that LP investment is always going to be passive. The exception is if you are on the GP side and you also have an LP stake, then your entire investment is going to be whatever, if you hit that non-passive on the GP side, the entire investment will be non-passive. But the consulting hours, you also have to start asking like, well, what am I actually doing on the consulting hours? If you're bringing significant value to the table, then maybe you have a case. In my experience, a lot of the consulting hours are just kind of flub hours to try to meet those hour tests, and the IRS knows that. So just be careful. All right. So we've talked about losses a lot, but we also have to talk about excess business losses and how this works. If you don't have business income, meaning you just have a W-2 and you start investing in rental real estate, you don't have business income, the rental real estate just gives you losses. The maximum loss that you can claim from your rental real estate portfolio is $250,000 if you're single, $500,000 if you're married filing joint. These are new rules as of 2021. Okay, so this went into effect January 1st, 2021. If I have $200,000 of business income, what is business income? It could be 1099 income as a real estate agent. It could be net profit from my flipping or construction activities. Could be net profit from my CPA firm. If you have $200,000 of business income, then the maximum loss that you can claim from your rental real estate tax losses is $250,000 plus $200K, so $450,000 if you're single, or $500,000 plus $200K if you're married filing joint, so $700,000 if you're married filing joint. So basically, the way to remember this is every dollar of business income plus $250K or $500K if I'm married. That's the amount of loss that I can claim from my rental real estate activities. Now, this is only non-passive losses. I can go and invest in an apartment complex, get $1 million tax loss, and that tax loss is just in the passive bucket, and it offsets, passive income and all that stuff, and then the remainder just gets suspended. That's fine. That's not a big deal. This is only when we're moving the property out of the passive bucket and into the non-passive bucket. So the purpose of this is to, again, prevent people with high W-2 jobs from eliminating their income. So if I have $1 million W-2 job as a physician, or I work out in San Francisco for Facebook or something, got $1 million W-2 job, the maximum loss that I can claim if I don't have any other business income is going to be $250,000 from real estate if I'm single, or $500,000 from real estate if I'm married filing joint. So business income plus 250 or 500, that's the maximum loss that I can claim for my rental real estate activities. This is a fun one, 100% business meals. So for the rest of this year, so this is 2021 and 2022, your business meals are 100% deductible. This was implemented with I believe the CARES Act. No, it was December 2020. The idea was to try to revitalize the restaurant industry. So instead of normally business meals are 50% deductible, and they're going to go back to 50% deductible starting in 2023. But for the next 11 months, you can 100% deduct your business meals. We don't need to talk about this. This is an old slide. Actually, let's talk about it real quick. So the Biden tax plan that everybody was talking about a couple months ago is effectively dead. It's not going anywhere else at this point. And Senator Manchin has just been a blocker to it. It did have some interesting things. It ended up not having anything negative for real estate. I listed out a bunch of stuff that was talked about here, but all of this stuff ended up getting stripped out of the bill. And it was a pretty vanilla bill as it pertains to investing in rental real estate. But there were some interesting like tax credits in there for owning electric vehicles and stuff like that. So that was kind of interesting. And the last thing, the biggest one, the biggest tax deduction that investors miss is something called partial asset dispositions. And the way that this works, the theory goes, if I buy like a single family home, and then I replace the roof a couple years later, I should be able to write off the cost of the roof that no longer exists, right? Because if I don't, then I'm technically depreciating the value of two roofs. I'm depreciating the value of the roof that came with the property, and I'm also depreciating the value of the new roof. So I've got one roof on my property, but I'm depreciating two roofs. So a partial asset disposition allows you to deduct the cost of any component that you rip out of the property that you do on any rehab or anything like that. You can't use partial asset dispositions in the same year that you acquire the property. So it does have to be the next tax year. So if you're going to do a rehab, do it the next tax year, not if possible. Obviously, it's not possible all the time. Multifamily properties, you want to stagger your rehabs over multiple years, and you'll be able to use partial asset dispositions as a result. But this is the biggest tax miss that we see. And it's also the most costly. This is more costly. Like not doing this is more costly than not qualifying as a real estate professional. And the reason for that is one, if I can write off the cost of the roof that no longer exists, if I can write that off today, I'm going to get a tax benefit today. But also when I sell the property later, if I've written off the cost of the roof that no longer exists, then I don't have any depreciation recapture associated with the depreciation of the roof that no longer exists. That's no longer my property. So you avoid taxes today because you have an expense today by writing off the cost of the old roof. And you also avoid taxes later via not having additional depreciation recapture. So you're kind of like double dipping almost. But at scale, you talk about large multifamily properties, this thing is like, it's so widely missed. And it's a very easy thing for our firm to come in and fix. Well, I shouldn't say easy, but it's a very easy thing for our firm to come in and identify and show you how much you've been missing over the years. So make sure that you have a conversation with your CPA about something like that. We have, this is my contact information. You're welcome to email me. If you email me, my assistant will most likely be responding to you. I get lots and lots of emails. Not that I would love to respond to everybody, but I just don't have time. But we do have a Facebook group that I highly encourage you to go join. There's 8,100 people in it. Most of them are real estate investors, if not all of them are real estate investors. But that is facebook.com/groups/taxsmartinvestors. And we have courses and things like that we periodically drop in that group as well. But there's questions on real estate professional status and short-term rentals literally every single day in that group. And we jump in and answer them. And people in our network also jump in and answer them too. And that's it. Thanks for hanging in there.
Brandon, you're the man. So it's surprisingly, we had, like 75% of the people stay. And I know that a lot of people have other meetings at 8 p.m. So you must have been, enthralling. I loved it, man. This was for me, like I'm going to rewatch this. And this is something that I feel very, very powerful for us. And important. So I truly appreciate your time tonight.
Yeah, thanks. And just like my closing thoughts here are, if you CPAs are a prideful bunch. I have learned that in my time, and oftentimes they are wrong with the nuances. So don't let your CPA or tax advisor tell you that you can't do something. Just start asking them questions and have them do a little bit more research. And oftentimes they will surprise themselves. It kind of depends on what type of shop you're using. If you're using a shop that understands real estate, you're not going to run into any issues. But if you're using like a local CPA or the CPA that doesn't clearly or obviously have a ton of real estate investor clients, you might have to collaborate with them a little bit more. It doesn't make them a bad CPA. It just means that they just aren't experienced with the nuances. So don't let tax professionals, prevent you from taking tax benefits that you otherwise could.
Thank you very much, Brandon. Again, I really enjoyed your presentation and I learned a ton, and still some of the things I don't understand, I gotta go rewatch. I'm sure everyone else is probably feeling the same way. But thank you everyone for joining tonight. We learned a ton. Again, good stuff today. So thank you very much, Brandon, for coming. And everyone, thank you for coming and peace out.
Thanks, everyone.
Thanks, guys.